Welcome to today's Explainer. Listen, we're looking at one of the absolute most fascinating and honestly counterintuitive dynamics in modern finance right now. We're examining the stark reality of the 2026 crypto market. On one hand, we're seeing this massive real-world adoption of blockchain technology by actual sovereign nations and global banks. Yet somehow, this incredible fundamental growth is just violently clashing with extremely depressing price action for major assets like XRP and Chia. It's this massive disconnect between what the market is pricing in and what the infrastructure is literally doing behind the scenes.
So, here's the million-dollar question we're going to dive into. If this technology is actively being utilized by global banks for billions in daily settlements and by sovereign nations to build out national infrastructure, why in the world are the token prices tanking? Really think about that. How can utility be at an absolute all-time high while market sentiment is sitting somewhere near absolute zero?
To truly grasp the scale of this disconnect, we need a bit of an ice bath reality check right up front. 99.9%. That is how much the cryptocurrency Chia has plummeted from its 2021 all-time high. It's currently trading under $2.25. And meanwhile, a legacy titan, a giant like XRP, is facing similar, just relentless downward pressure right now in early 2026. The retail market looks at this and sees a complete disaster. But, we have to ask, is that really the whole story?
Here is our game plan for today. First, the crypto disconnect. Second, macro headwinds. Third, XRP as the mega cap bridge. Fourth, its institutional portfolio role. Fifth, Chia's real-world asset infrastructure. And finally, number 6, forecasts and future outlooks. All right, let's jump straight into Section 1, the 2026 crypto disconnect, market pain versus fundamental growth.
Moving right along to Section 2, macro headwinds and policy delays. Basically, the gravity pulling these prices down. According to Pin2 News, there are 6 very specific headwinds suppressing assets like XRP right now. First off, really strong U.S. economic data is boosting the dollar, which naturally makes yield-bearing assets way more attractive than crypto. Second, you've got these ongoing U.S. crypto policy and regulatory delays. Institutional investors are just sidelining their capital until someone gives them clear legal parameters. And that feeds right into the third and fourth points, a global risk-off sentiment and declining exchange trading volumes. People are just hesitating. Finally, add in XRP's historical correlation to broader market drops led by Bitcoin, plus a messy web of jurisdictional regulatory risks all over the globe, and, well, it's literally a perfect storm of caution. We're operating in a macro environment defined by hesitation.
Okay, Section 3, XRP, the mega cap bridge. Let's look beyond that bearish sentiment for a minute.
Now, if we look at the CF benchmarks data, one crucial point becomes crystal clear. Even with all those macro headwinds we just talked about, XRP still commands a massive $143 billion market cap. That actually gives it a 5.8% weight in the CF Broadcap Index. So despite the price action, it is undeniably a digital megacap. To put that in perspective, in traditional finance, ignoring an asset of this relative size would be like an S&P 500 index fund just deciding to ignore a major blue-chip tech stock. You just can't do it. Its sheer size practically demands institutional attention.
So why does XRP hold that mega cap status? Well, it's all about the underlying engine, the XRP ledger. Unlike Bitcoin or Ethereum, this ledger was purpose-built specifically for payments. It totally bypasses that energy-heavy mining process. Instead, it uses a super lightweight voting system to settle global transactions in, get this, an incredibly fast 3 to 5 seconds. And it does all of that for network fees measured in literally a fraction of a cent. It is engineered from the ground up purely for high-speed, cost-efficient value transfer.
And that underlying tech powers something called on-demand liquidity, or ODL. This is an enterprise-grade product that uses XRP as a real-time bridge between different fiat currencies. Why is that a game changer? Because it allows major global banks to completely ditch holding trillions of dollars in pre-funded Nostro accounts all over the world. Management reports that over 200 financial institutions, we're talking heavy hitters like Bank of America and Standard Chartered, are actively testing or already using ODL. It's powering billions in cross-border settlements. This isn't theoretical. This is real-world utility happening right this second.
Which brings us to Section 4, XRP's institutional portfolio role, data-driven diversification. Take a look at the data on correlations. XRP exhibits roughly a 0.47 correlation to Bitcoin and about 0.48 to Ether. That is considered a low pairwise correlation. Basically, it means its returns kind of march to the beat of their own drum, driven by independent market factors, not just blindly following whatever Bitcoin is doing on a given day. Now, if you're an institutional portfolio manager, this is exactly what you want to see. It makes XRP an excellent diversifier, helping you reduce unsystematic risk, those random shocks that hit the broader crypto space, while still keeping your exposure in the market.
And the risk profile? It's super interesting. The data reveals a very distinctive asymmetrical risk-reward setup. In plain English, XRP offers massive upside potential. Historically, we're talking single-month gains of over 244%. But here's the kicker. It actually cushions extreme downside losses significantly better than its peers. Its worst monthly loss of around 29% is way, way shallower than those brutal 48% to 58% plunges we've seen from Ether and Solana. It gives allocators that asymmetrical upside they crave, but with a much softer landing on the downside.
All right, let's pivot to Section 5, CHIA, Real-World Asset Infrastructure, the 99.9% paradox.
The contrast here is just absolutely wild. On the one hand, you have the market reality. CHIA is hovering near absolute all-time lows, down 99.9% with a tiny little $35 million market cap. But then, you look at the fundamental side, and CHIA is literally partnering with the World Bank's climate warehouse. Entire sovereign nations, places like Bhutan and Costa Rica, have actually adopted CHIA's blockchain to manage their national carbon inventories. Let that sink in. This isn't some beta test. This is active, real-world adoption happening at the country sovereign level. So what's the fundamental tech driving this level of sovereign adoption? It comes down to CHIA's unique consensus mechanism and its programming language, CHIA Lisp. First, it uses a highly eco-friendly proof of space and time model instead of energy-intensive mining. But arguably way more important for big institutions, it features programmable transaction clawbacks. Meaning, if you send funds to the wrong address, you can actually cancel that transaction within a specific time window. It's an enterprise-grade security feature that fixes routing errors, which is a massive safety net that networks like Ethereum just heavily lack.
Finally, Section 6, Forecasts and Future Outlook, Catalysts on the Horizon. Let's see where this is all heading.
For CHIA, there are some massive structural catalysts looming right now. The network is currently awaiting potential SEC approval for a registered dividend product through Permuto Capital. If that goes through, CHIA literally becomes the first blockchain ever to host an officially registered U.S. securities product. On top of that, they filed a confidential S-1 for an initial public offering, and this whole strategic move is being spearheaded by Gene Hoffman, the former CEO of NASDAQ. I mean, that kind of traditional, heavy-hitting regulatory validation could be the exact shock CHIA needs to break out of this slump. In tracking the data, we can actually build a clear timeline for what CHIA's potential recovery might look like based on Indonesian rupiah market forecasts. Analysts expect 2026 to basically just be a period of consolidation. But if those real-world asset adoptions and that whole IPO narrative really take hold, 2027 could spark an initial recovery, pushing back up to the 342,000 rupiah level. By 2028, you factor in the broader market cycle, which leads us toward a highly optimistic 2030 target of 3.2 million rupiah, assuming enterprise adoption truly reaches massive, undeniable scale.
So, I'll leave you with this final, somewhat provocative thought as we wrap up today's explainer. We've looked at the data, the technology absolutely works, major banks are actively using it, and entire sovereign nations are building upon it. Will the verifiable, real-world utility of these networks inevitably break through all this current macroeconomic pessimism? Or is it possible that market sentiment can just ignore a fundamental reality forever? It's something every single one of us following this space needs to watch incredibly closely. Thank you so much for joining me for this explainer. Keep your eyes on the data and keep learning.